Look at a teaspoon of white sugar, and it seems almost weightless. For most of us, it is so cheap that spilling it hardly matters. But place the same spoon on a London table 3 centuries ago, and it becomes the final piece of an economic machine stretching across oceans. Hidden inside those crystals are a tropical field, a mill that cannot stop, a merchant's loan, an insured ship, a customs officer, a refinery, and the stolen labor of people who receive none of the fortunes they created. Sugar began as a luxury guarded by the wealthy. Then its price fell. Ordinary families started stirring it into tea, and the fortunes surrounding it became larger than ever. That is the mystery. Sugar did not transform the world simply because humans like sweetness. It did so because a stalk of cane contains a deadline. Once cut, its juice begins deteriorating. The crop must be moved, crushed, and boiled quickly. That ticking clock forced field, factory, finance, and coerced labor into one tightly coordinated system. Follow a stalk from the soil to the mill, and then follow one barrel of raw sugar across the Atlantic. By the time it reaches an ordinary cup, it will have connected plantations to banks, slavery to insurance, consumer taste to naval power, and millions of tiny purchases to global fortunes. Before sugar could build those fortunes, sweetness first had to survive a journey. The oldest cultivated sugar canes emerged through a long process of selection in and around New Guinea. People valued the tall grass for the sweet juice inside its stalk and carried different varieties through Ireland, Southeast Asia, and across the Pacific. As cane moved west, it encountered other wild grasses and new growing conditions. In South Asia, growers and processors developed ways to crush the stalk, boil its juice, and turn that liquid into concentrated sugar. The decisive breakthrough was not sweetness itself. Honey was already sweet. Fruit was sweet. Fresh cane could be chewed. The breakthrough was making sweetness portable. A crystal could be stored, divided, weighed, and carried far beyond the field where it was produced. Juice spoiled. Crystals traveled. That difference transformed a local plant into a tradable commodity. Techniques for growing and refining sugar spread through Persian and Islamic commercial networks and into the Mediterranean. But in medieval Europe, sugar was not a pantry staple. It appeared as a medicine, a spice, and a display of status. It could decorate an elite feast, sweeten an expensive preparation, or sit in a locked chest beside other rare goods. Its high price reflected more than scarcity. Cane demanded warmth, water, and intense processing, while European consumers lived far from the climates that suited it. Every mile between field and table added merchants, transport, and risk. The rich paid because sugar offered something beyond calories, visible access to a distant commercial world. Yet luxury alone could never create mass fortunes. A few aristocrats buying tiny quantities placed a ceiling on demand. To become truly powerful, sugar had to escape the palace without losing the profit. The first great experiment took shape on Atlantic islands such as Madeira. Portuguese colonization brought warm land under European control. Genoese finance helped supply capital. Mediterranean knowledge helped organize cultivation and processing. Water-powered mills crushed the cane. Enslaved Africans increasingly supplied forced labor. Madeira was not yet the enormous Caribbean plantation world, but it assembled crucial parts of the model: outside investors, appropriated land, specialized machinery, export markets, and coercion. The experiment then moved to Sao Tome, where sugar, monoculture, and enslaved labor were combined on a still larger tropical scale. From there, the system crossed the Atlantic to Brazil. What traveled was not merely a plant, it was a business design. That design began with a physical problem. A field of wheat can be harvested and the grain stored before milling. Cut sugarcane is different. Waiting reduces the sugar that can be recovered from it, so the mill must stand near the field, and harvesting must be synchronized with crushing. The extracted juice then has to be clarified and boiled through a sequence of heated vessels before crystallization. That requires buildings, rollers, kettles, fuel, animals or water power, skilled workers, barrels, and transport. A sugar estate was therefore not simply a large farm. It was a factory surrounded by its raw material. Long before the first profitable shipment, somebody had to pay for the land, equipment, and workforce needed to keep that factory moving. This created sugar's first great economic advantage and its first trap. Mills were expensive, but once built, owners wanted to push as much cane through them as possible. Larger operations could spread the fixed cost across more barrels. A planter with access to capital could buy neighbouring land, expand cultivation, and keep the crushing equipment busy. A smaller farmer without a mill had to sell cane quickly to someone who owned one, accept unfavourable terms, or leave the business. Scale rewarded scale. In places such as Barbados during the 17th century, the shift towards sugar transformed landholding and society. Properties consolidated, equipment multiplied, and those unable to finance the transition were often pushed aside. The landscape became increasingly organised around one crop and one relentless production schedule. But machinery alone could not create a sugar fortune. Cane fields demanded planting, weeding, cutting, and hauling. Mills and boiling houses demanded dangerous work under constant pressure. European empires solved their demand for labour through escalating violence. In Brazil and across the Caribbean, millions of enslaved Africans and their descendants were forced into a system that treated human beings as saleable property. Sugar did not invent slavery, and not every place produced sugar in the same way. But the crop's profitability, labour demands, and capacity for expansion intensified the Atlantic demand for enslaved labour on a devastating scale. Plantation accounting recorded people beside livestock, tools, and debts because colonial law allowed owners and creditors to assign them monetary value. The fortune appeared in European ledgers. The cost was imposed on captive bodies. Those people were never passive parts of a machine. They preserved families and cultures under extraordinary pressure. They negotiated where they could, slowed work, damaged equipment, escaped, formed maroon communities, and rebelled. Every plantation carried the fear that the people creating its wealth would refuse the system built upon them. Owners responded with surveillance, punishment, and armed force, adding another layer of cost to an industry advertised as naturally profitable. The violence was not separate from the business model. It enforced the labour regime on which projected harvests, loans, and shipping contracts depended. A field could look productive on paper while concealing a permanent struggle over who controlled each hour of human life. Now imagine a planter preparing a new estate. Before any sugar reaches Europe, he needs equipment, buildings, provisions, and shipping. A merchant may advance these on credit in return for future crops. The planter appears wealthy because he controls land, machinery, and people whom colonial law calls property, yet harvests years ahead may already be promised. Finance carried this logic surprisingly far. Beginning in 1754, Dutch financiers pooled mortgages on plantations in Suriname and sold certificates to distant investors. The security behind that debt included plantations and enslaved people legally treated as collateral. An investor in Amsterdam could collect interest without seeing either a cane field or the human beings whose legal status supported his claim. When excessive lending, weak valuations, and shocks undermined the loans, the securities crashed. Sugar could transform next year's harvest into money today, but it could also transform imagined wealth into a financial crisis. When a barrel left the estate, a queue of claimants travelled with it. The local factor arranged sales and supplies. The shipowner charged freight. The insurer priced the risk of hurricanes, enemy fleets, piracy, and loss at sea. Creditors expected repayment. Refiners would add value in European ports. Governments collected duties. Wholesalers and shopkeepers took their margins. By the time the final sugar reached a consumer, wealth had been distributed through a network much wider than the plantation itself. This is why sugar fortunes appeared far from any cane field in commercial houses, port cities, refineries, shipping fleets, and financial institutions. The plantation created the commodity, but trade and finance multiplied the number of people who could profit from it. Marine insurance was especially important because an ocean could erase an entire season in a single night. Investors were more willing to fund distant commerce when risk could be divided among underwriters rather than concentrated in one merchant. Insurance did not make the voyage safe. It made loss calculable and transferable. The same financial machinery covered ships carrying plantation supplies and ships returning with sugar rum, and other goods produced by enslaved labor. As Atlantic commerce expanded, routes became more complex than the tidy triangle often drawn in textbooks. Some vessels carried captive Africans across the Middle Passage. Others specialized in transporting bulky plantation produce to Europe. Credit, bills of exchange, and insurance connected voyages that no single ship completed as one neat circuit. The barrel finally reached a refinery, but the economic journey was not over. Raw sugar arrived in heavy forms that required further processing. Refiners clarified it, boiled it again, and produced loaves, powders, and grades for different buyers. Molasses, once a residue of processing, became the basis for another profitable commodity, rum. Nothing valuable was allowed to remain waste for long. A plantation could sell sugar, molasses, and sometimes rum. Merchants could ship them. Refiners could separate markets by quality. Governments could tax them. Each additional stage created work and profit, but it also placed more distance between the consumer and the conditions under which the cane had been cut. Governments understood that sugar was something to tax and protect. European powers restricted colonial trade, reserved markets for their merchants, and used naval force to defend profitable routes. Sugar islands became strategic prizes. Wars captured or devastated them and moved prices in distant cities. Empire protected the sugar system, while customs revenue helped support empire. A breakfast spoonful could carry the cost of forts, warships, and officials without the consumer ever seeing them. This did not make every planter rich. Many lived behind impressive acreage while owing their next crop. Merchants could charge commissions across several estates, refiners could serve many suppliers, and insurers could spread risk across many voyages. Sugar concentrated brutal power on the plantation, but distributed financial opportunity across the Atlantic economy. The barrel accumulated claims at every stop, while the people with the strongest legal claims were rarely those who performed the hardest work. Then sugar found three perfect partners: tea, coffee, and chocolate. These drinks arrived through other expanding trade networks, and each had a bitter taste that sugar could soften. Together they created habits that repeated daily. A sculpture made of sugar might impress guests once. A cup of sweetened tea could be purchased again tomorrow and the day after that. This changed the arithmetic. Producers no longer needed to earn the highest possible margin from a tiny elite if they could sell vastly larger quantities to a growing market. As supply expanded and prices fell, sugar moved from royal display toward ordinary consumption. Lower prices did not destroy the fortune. Volume rebuilt it on a larger foundation. For working people, sweetened tea offered stimulation, warmth, and quick calories in a convenient form. For merchants, it linked several commodities in one purchase: imported tea, imported sugar, pottery, shipping, and retail. Demand for one product strengthened demand for another. More consumers justified more plantations. More plantations produced more sugar. Greater supply helped push prices down, attracting still more consumers. This feedback loop transformed taste into infrastructure. Refineries expanded. Grocers stocked regular supplies. Governments learned to adjust duties. Households reorganized small rituals around products that previous generations had considered exotic. Sugar became ordinary, not because its production became simple, but because an enormous and violent system made its complexity invisible at the point of sale. Few places revealed that contradiction more clearly than the French colony of Saint-Domingue. By the late 18th century, it was an extraordinarily productive center of sugar and coffee, creating immense wealth while relying on extreme coercion. In 1791, enslaved people began the uprising that grew into the Haitian Revolution. They fought armies, destroyed slavery's legal foundation, and declared an independent Haiti in 1804. But France later used the threat of force to demand compensation for former slaveholders as the price of recognition. The original demand of 1,825 was 150 million francs. It was later reduced and repeatedly refinanced, burdening Haiti for generations. The people who had created the colony's wealth abolished the institution that stole it, and the former colonial power presented them with a bill for their own freedom. The revolution disrupted production and frightened slaveholding societies, but demand for sugar did not disappear. Production expanded elsewhere, including Cuba and Brazil. This exposed another feature of commodity capitalism. When one source becomes politically or economically costly, buyers search for another. The crop migrates, capital migrates, and coercive practices can migrate with them. Abolitionist campaigns attempted to interrupt this logic by making consumers confront the labor hidden inside the product. In Britain, some households refused sugar produced by enslaved people. These boycotts did not end slavery by themselves, but they turned an everyday purchase into a political choice and challenged the claim that consumers had no connection to distant plantations. Britain abolished its participation in the transatlantic slave trade in 1807, but slavery continued in most British colonies until the 1830s. When Parliament finally legislated emancipation, the financial settlement revealed exactly whose loss the state recognised. The British government authorised £20 million in compensation for slave owners. The formerly enslaved received no equivalent payment for generations of stolen labour. Many were also forced through a period of apprenticeship before full freedom. The compensation records mapped ownership and mortgage claims across Britain, showing that interest in colonial slavery reached far beyond resident planters. Sugar wealth had travelled home through families, banks, investments, buildings, and political influence. Emancipation ended legal ownership within those colonies, but it did not reverse the accumulated transfer of wealth. Nor did emancipation automatically create a free and equal labour market. Plantation owners still wanted a large, disciplined, and inexpensive workforce. Across the 19th century, colonial governments and employers recruited indentured labourers, especially from India, for sugar colonies in the Caribbean, Mauritius, Fiji, and elsewhere. Contracts promised wages and eventual freedom, distinguishing indenture legally from slavery. In practice, deception, debt, restricted movement, harsh punishment, and enormous bargaining inequality often trapped workers in abusive conditions. More than 500,000 indentured labourers were introduced into the British West Indies between emancipation and the First World War. The law had changed, but the pressure to keep the consumer price low continued pushing costs onto workers with the least power. Sugar's tropical monopoly was also challenged from an unexpected direction. European researchers established that the sugar in beets was chemically the same sucrose found in cane. Breeders increased the useful sugar content, and war accelerated investment. During the Napoleonic era, blockades restricted access to Caribbean cane sugar, giving continental governments a powerful reason to support domestic beet production. Factories learned to extract sugar from a root grown in temperate fields. Beet sugar did not end plantation coercion, and cane remained enormously important, but it changed the strategic map. A European state no longer had to depend entirely on tropical colonies for sweetness. Competition between beet and cane helped drive industrial efficiency, protective tariffs, and even greater mass availability. Industrial efficiency reshaped the cane factory too. In 1843, Norbert Rillieux, a free man of colour born in New Orleans, patented a multiple effect vacuum evaporator. Instead of boiling cane juice in exposed kettles, his system reused steam across enclosed vessels and lowered the temperature needed for evaporation. It cut fuel use, improved control, and made processing safer and more consistent. Technology increased the amount a mill could recover, but it did not automatically liberate workers in the fields. Modern machinery and coerced labour could expand together. The economic question remained: who owned the equipment, who controlled the crop, and who captured the savings? By the late 19th and 20th centuries, sugar looked less like a rare spice and more like a standardized industrial ingredient. It entered preserves, confectionery, baked goods, and eventually processed food and drink. The winning business might now be a large refiner, a manufacturer using sweetness to sell another product, or a distributor placing it everywhere. The old fortune depended on scarcity. The modern fortune often depended on ubiquity. Sell a little to nearly everyone, repeatedly, and the smallest crystal becomes an enormous revenue stream. Now, return to that teaspoon, rewind it. The white crystals lead back to a refinery, The refinery leads to a ship or factory. The ship leads to a barrel. The barrel leads to a boiling house, a mill, and freshly cut cane. Behind the cane stands a ledger filled with loans, insurance, duties, and promised harvests. Behind the ledger stand empires that seized land, protected trade, and wrote laws deciding who could own property and who could be treated as property. And behind every clean number are people who planted, cut, carried, crushed, and boiled the crop, resisted exploitation, and built lives in conditions the accounting was designed to hide. The fortune was never contained in the sugar crystal alone. It sat in control of the mill, the loan against the next harvest, the ship, the insurance policy, the refinery, the tariff, and the shelf where millions of small purchases became one vast stream of money. Sugar became cheaper because production grew larger, finance spread risk, industry extracted more value, and workers were forced to bear costs the customer never saw. That is how a luxury became ordinary without becoming economically small. The plantation was more than a farm. It was an early global machine joining industrial processing, credit, coerced labor, imperial protection, and mass consumption. A sugar crystal disappears the moment it reaches the tongue. The fortunes and the world built around them did not.